And when we had stopped last time, we got up to this investigation of a business, right? Was my recollection. And I didn't want to go through it at that time because I was a little concerned that, we wouldn't be able to get through it properly. And I hate to start a topic and then have to restart it in the next chapter. So basically what's going on here with the investigation of business is the federal government's going to allow us to make deduction to do some steps to add on to our existing business or get into a new area of business, okay? Now, if we're talking about an existing business, we're going to see, we're trying to expand an existing business, we're going to see that they'll allow us to deduct that. If it is a new business, we have to actually enter into that new business to be able to deduct that. And otherwise, people would just be turning every vacation they ever took into a business investigation. Hey, I'm going to travel to Europe to see if I want to open up pizza parlors in Italy. Meanwhile, you're sitting there and you're an accountant. Okay, well, that's just a bogus way of trying to deduct the expenses for a vacation. So they're going to make you actually enter into that business to deduct those expenses. And if you can't necessarily deduct all of those expenses if you're entering into a new business. Okay, so let's just look at the slide and you'll get some more feel for the details here. And I guess I should get into slideshow mode. Yeah, right here. I can't see my mouse here, slideshow. Okay, so investigation of a business, and that can include costs such as traveling to the new locations where the businesses are going to be, okay, any marketing, survey, legal and accounting services, okay, and the tax treatment and whether or not we're going to be able to expense that really depends on two primary things. Is it a business that I'm already currently involved in? And whether or not the acquisition actually occurs are the two key factors you were going to see that's going to determine how we're going to treat this. And so you take a look at the next slide, and if the taxpayer is in the same business. So what's happening? I'm an accountant, and I want to open up an accounting firm in another state or something, right? By the way, can I take my California CPA and practice in another state? Yes, you can. Most states will accept California's license, almost like a driver's license. So you could literally drive in to that other state and practice with your California CPA. Now, if you're a firm and you're going to set up a firm, then most of the times they'll accept your California CPA as a firm, but you can't just drive in and start practicing. They're going to require that you do some registration process first. But I'm a California CPA. I want to start practicing in Nevada, let's say, right? Because I figure, hey, the Raiders are moving to Nevada. I'm going to follow the Raiders, whatever. So what happens? I start to investigate that process, and I travel to Nevada to do that, then I'm staying in the same business, right? And if that's the case, then they're going to go ahead and allow me to do what? Allow me to go ahead and deduct the expenses associated with investigating that, travel costs, lodging, all of that, and it does not matter if I actually get into that additional business. I can still deduct those. They figure it's like, hey, the same business that we would have liked to take the expense for anyway, but now you're just looking at expanding that same business. So they go ahead and allow us to deduct that. Now that is different if I'm getting into a different business. So now I'm thinking about opening up a pizza parlor. I'm an accountant. I'm going to open up a pizza parlor in Italy, let's say. So I travel to Italy to find out what the demands for pizza are, right? So tax results depend on whether the new business is acquired. If not acquired, forget about it. None of it is deductible, okay? But you get over there and you say, the one kind of pizza they don't have in Italy is American pizza. And we're going to be American pizza in Italy or something is going to be your niche. And so you go ahead and you start to get into that business. Investigation costs must be capitalized, but they provide an exception and they tell us that it is okay to expense, and you can expense the first $5,000. Any excess expenses then would have to be amortized over these 15 years, 180 months. And in arriving at the immediate deduction, any amounts in excess of 50,000 are going to have to offset that initial 5,000 automatic deduction that I could have taken. So as you get to larger expenses, they actually start to take away what? Some of larger expenditures. It's not an expense because you can't expend it, but larger expenditures towards the investigation, they start to take away some of that 5,000 immediate upfront deduction. Okay, so if you want a 5,000 immediate upfront deduction, don't spend too much money in investigating that, right? Okay, but you'd have to acquire the business in that situation. Okay, so let's just take a look at Tina here, who operates 10 restaurants located in various cities throughout. She travels to Atlanta to discuss the acquisition of an auto dealership. She's doing what? She's a restaurant owner. She's staying in the same business? No, she's going to auto dealerships. So she incurs legal accounting costs associated with the potential acquisition, and they total up to $52,000. What can she deduct? Well, she has that $5,000, but remember, they got to reduce the $5,000 by any amounts that are over what? $50,000, right? So she goes ahead and she can immediately deduct $3,000, which is going to be what? This $5,000 minus the $2,000 that she went over the $50,000 threshold, right? Okay, let's see. You're looking at that like, well, I don't know. This is stupid, isn't it? I mean, just let her take the $5,000. I'm not sure why they're sitting there and saying that she's got to reduce it by amounts over $50,000, but what are you going to do, right? And so the remaining $49,000 then would be amortized over 180 months. And so for calendar year 2017, she can still go ahead and do what? Take this additional amount, which is the $3,000 plus the portion that she's amortizing for the 3 months, October, November, December. And so they'll let her go ahead and take that portion. I guess they're just trying to kick her into an amortization process here sooner rather than later. Okay? All right, so another one of those interesting rules. Yes, sir?
These legal and accounting costs include like food, restaurants, hotels.
Well, she had legal and accounting costs that they called out in this question, but if she had lodging... You know, that could be me. I do that to Siri's. I don't know. They start talking back to me. Mine does it too. I don't press the button, and all of a sudden it starts listening to me. I don't know what it is. It must be the voice of annoyance wakes up the phone or something. But she could take the lodging and stuff too. They just in this case called out legal. But yeah, lodging cost, travel cost, all that. That's why it's better to do what? Stay in the same line of business, right? And kind of throw in a little vacation trip along with this, I'm not telling you to lie, but this business they can't see that I'm doing this over the recording. That business investigation, costs, okay, you're in the same business, decided not to acquire, you can still deduct everything and go ahead and see the Mona Lisa in the meantime, okay? All right, so you come over and you take a look, and I'm just sticking with the Mona Lisa. Oh, where Mona Lisa's in France, right? In the Louvre? Yeah, sorry. So I was thinking she would be in Italy, but no, she's in the Louvre. Okay. All right. So you come over and you take a look now at this quiz question. And again, guys, remember the quiz questions are also part of the Word file. So you can download those. And I think I've said this a couple times. My recommendation is that you get the Word file and you block the answer, so that you don't just sit there. And I noticed it, not with you guys, but I noticed it in some of my undergraduate classes. I see them, and they're getting all the answers right, and I'm thinking it's because they really understand the material, but they see the answers sitting there, and then they back into what the correct answer is, and they're, impressing me. Wow, you really know that. But then I realized, no, you're looking at the answer and you're kind of backing into and justifying your way through, and you feel like you understand the material when you really don't. So when you go through those, I would always hide that answer. That's why I give you the Word file so you could delete it and print it and take it like a real test in prep for the midterm. Okay. IRS, a calendar year cash basis taxpayer, owns and operates several TV rental outlets in Florida and wants to expand to other states. Sounds like the same business to me, right? Okay. During 2017, she spends $14,000 to investigate TV rental stores in South Carolina and $9,000 to investigate rental stores in Georgia. Can she deduct those? Can deduct all of it because what? She is in the same business, right? Okay. All right, good. Come over and let's take a look at hobbies. Okay, now what happens here? They're going to allow us some deduction for hobby losses, but they want to be careful that somebody doesn't try to turn a hobby into a business and take all kinds of losses against their what? Ordinary income. Okay, and I had a buddy who thought that he could get away with this when we were in college. I think I told you about him, wanted to be a rock star, and he was spending all this money on music equipment and stuff when he's saying, well, it's a business, and he kept showing these losses period after period and would carry those over to his 1040. And he says, I'm like, I don't think they let you get away with that for long. They're going to, pull the trigger on you at some point. And finally they called him in and they declared it a hobby because he never showed an income. And that was a way that they determined whether or not it was a business. Now, they do look to other factors. And I had kind of advised him on that. And he did do that part. And that he went ahead and set up separate bank accounts and stuff for the business. Because if you commingle your personal with this supposed business that they're going to call out as a hobby, that alone could cause them to call it a hobby because you're commingling your bank accounts and that sort of stuff. So it's not like just because you show a profit period after period that they will not call that a hobby. They could still, the burden of proof would be on them, but they could still call it a hobby, and they might look to things like how you're doing your accounting, how careful you are in your accounting, commingling of personal funds with business funds, that sort of thing. Okay, so a hobby defined is something that someone does out of fun, right? Okay, so therefore, if you start an accounting business, will they ever call that a hobby? I highly doubt it, okay, because what? Nobody likes accounting, right? Okay, so it's got to be, they're going to look at it stuff like, are you being a fisherman, a boat, or rock star, or whatever, okay? Now, if an activity is not engaged in for a profit and you just come right out and you declare, hey, I'm doing this for fun, then the hobby expenses are deductible only to the extent of hobby income, and we're going to see that they are not deductible as a business expense. They are going to be deductible as an itemized deduction, and they're going to be subject to a 2% limitation as to what they'll let you actually deduct on that, and that's actually more towards Chapter 10, okay? But let's just take a look. If the activity is entered into for a profit, taxpayer can deduct expenses for AGI even in the amount of the expenses of the activity. In other words, you'll fill out a Schedule C, you'll have a loss on the Schedule C, and that loss will come forward onto the face of the 1040, right? Like we looked at last time. Okay, so, but it just really depends on whether or not you have entered into this for a profit. And again, if it's, a dental office, nobody looks at that and says, well, that's a hobby. You must like to look inside of people's mouths and yank their teeth out. And that's not that sort of thing. They're going to look to the nature of the activity that they're going to start to say, that's something that somebody could enjoy as a hobby as well. We're going to be looking at that a little bit differently. Okay. Now, it's often difficult to determine if there is something is a hobby. Sorry, guys. That's me. If something is a hobby or a regular business, and they look at these 9 different factors, and we're not going to go through the 9 factors. We're not going to go through any of them. I'm not going to expect you to know. I'm just telling you that one of them would be, hey, do you have separate bank accounts from your own personal, that sort of things. Okay, so there's different factors that they look at. The one key factor that we're going to study, though, is going to be this Section 183 presumptive rule. And they tell us that if an activity shows a profit in 3 out of 5 years, okay, and if it's horses, 2 out of 7, okay, for I guess horses take longer to turn a profit, okay, and so what happens? The activity is presumed to be a trade or business rather than a personal hobby, okay? Now, you got to be careful with that because it makes it sound like, okay, just turn a profit 3 out of 5 years and IRS, I'm bulletproof to IRS in terms of them calling this a hobby. No, it simply shifts the burden of proof from the taxpayer to IRS. So if you are showing a profit in 3 out of the 5 years, now IRS has to prove that that was not a business and that was a hobby, okay? And as a practical matter, it's unlikely that the IRS is going to say, well, you showed a profit, in 5 years, you always showed a profit, you always paid tax on that, but we're going to call it a hobby because we just feel like messing with you today, okay? It's unlikely that that's going to be the case. So it's more likely that what? You keep showing losses, you don't show that profit in 3 out of 5 years. You're saying that you got a music, rock and roll entertainment business, and they're going to say, no, you are not considered a business. We're going to call you a hobby, okay? Otherwise, if you don't show that profit, the taxpayer then would have to prove, no, this was really a business. And then you could start to show them some of the other things that have gone in that actually makes this a business, separate accounting, whatever, and you could try to convince them. My buddy could not. He lost that. He had to go ahead and pay this huge tax bill because he had been sitting there and taking losses from a Schedule C over to the 1040 against his W-2 income, and he was getting away with not paying a bunch of taxes, and then all of a sudden they said, nope, you are a hobby, and here's your bill. Please pay these taxes immediately. Okay, so he had to get on a payment plan with them of some sort. But anyway, so you take a look. What happens if you can't pay your taxes, by the way? What do they do to you? I mean, they could throw you in jail for that if it's enough of an amount, okay? But, if you ever have a client that's in a situation where they, sometimes you hear about people that don't file their taxes for like 3 or 4 years because they're like the guy that hides behind a tree and says, well, if I can't see you, you can't see me, right? Meanwhile, you see his head sticking out on either side. So, you're not going to really be able to hide from the IRS, right? And so if your client gets into a situation where all of a sudden, hey, we owe all these taxes and everything, IRS, you just call them. And they have all kinds of programs. They have, program where they'll let you get on installment payments. The interest rate is not horrible on that. They'll do an offering compromise. You can literally call them and say, look, I owe you $5,000. Will you take 4? And they may say yes in some cases. So administratively, we don't get into that in this class. There's a lot of options out there for taxpayers. There's also something called Taxpayer Advocate. And Taxpayer Advocate, although it is part of IRS, they are supposed to be looking out for your benefit and advising you as to your best options and that sort of thing. So there's different avenues, okay? But anyway, you take a look and you see these. Oh, guys, I apologize for the I don't know. There may be more or less, so don't say, hey, well, you skipped a slide on us. I don't know. I might have cut one out, and now it's not going to be, it'll be all of a sudden 6 of 8 if I don't use one. Anyway. So let's just take a look at it. This is a pretty good example, and they're saying it is a hobby the first year. Even though the person showed a profit, yes, it is still a hobby because they cannot show what? Income in 3 out of 5 years. They don't have 5 years, right? Okay, but it's unlikely that IRS is going to start to come in that first year and start saying, hey, this is a hobby, so they'll let it go for a while. Okay, then what? Next year there's a loss, still a hobby because we can't show income in 3 out of 5 years. Next year, profit, still a hobby because we can't show profit in 3 out of 5 years. 2013, still a hobby because we can't show profit in 3 of 5 years. 2014, now at least from the presumption, they shouldn't really say no because the burden of proof shifts from the taxpayer to IRS in 2014 because what? There was profit in 1, 2, 3 of the what? 1, 2, 3, 4, 5 years that we're counting. Now, it turns out to be a rolling 5 years, okay? So it's not like, hey, you did it once and that's it, 3 out of 5 years and you're good for life after that. It continues on, okay? And so we go into that 6th year, and because the 6th or 7th year, 1, 2, 3, 4, 5, 6th year, yeah, we go into that 6th year, and it is only a profit in 2 of the 5 rolling years now, right? Okay, so we roll forward with those years, and then when we get into 2016, of the 5 years now that have rolled into that preceded the 4 years plus 2016, that rolling 5-year period, no, because now there's profit in 3 of those 5 years. Okay, and again, the answer is that what? It really is telling us whether or not IRS is the one that has to prove whether this is a hobby. Okay, if an activity is deemed a hobby, we can only deduct expenses to the extent of income. We cannot deduct hobby losses. Okay, and those expenses are going to be what? Are going to be deductions from AGI. In other words, they are treated as itemized deductions, and we are going to be limited to 2% of our AGI. We cannot take more than 2% of our AGI as a deduction for a hobby. And again, it's up to what? Up to any income. So if the hobby made no money, you get no deduction, right? It's only backing off the income from that. Okay, now you could deduct amounts that you could have taken as an itemized deduction anyway. So, and that would be kind of I guess you'd be doing that to try to limit having to pay the tax on the income from the hobby, but it's kind of 6 of one, half a dozen of the other, and that, you could take it anyway as an itemized deduction. Then they'll go ahead and let you take the whole amount. You're not limited to that 2%, because then it's just a question of where on the 1040 are you putting it at that point. Are you putting it on the Schedule A as a interest deduction, or are you putting it as a miscellaneous itemized deduction subject to the 2% limitation? Okay, but they'll let you take more than that if you're going to be taking it anywhere elsewhere on the Schedule A in our mortgage, interest, and our property taxes. Okay? Okay. Let's take a look at the order that we're able to take these hobby losses. Okay, so first, you have to take all of those that you could have deducted anyway. So apparently what this taxpayer is trying to do is reduce some income from hobby activity, right? They're trying to get that down to 0 because it's a hobby and they don't want to pay tax on the hobby income. So they first have to use it not as interest, not as property taxes up there on the 1040 for that category. They first have to take those. Then expenses that do not affect an adjusted basis of property that would go next. So it's things like your maintenance, your utilities. Then you would have to take expenses that are attributed to depreciation, that sort of thing that is going to affect the adjusted basis of your property, your cost recovery. When you take depreciation, they're going to make you recapture any costs because you're taking a tax benefit in a prior period for the depreciation. They'll make you reduce the basis of that property, so when you sell it, there's a larger gain on that property. We'll get into that more hopefully after the next midterm, but you would have to go ahead and take those next in order to reduce that hobby income down to 0. So they make you go in that order. Okay, so let's go ahead and let's take a look at the next slide, and you'll kind of see how this works. We've got 15,500 that this person has in hobby income. They don't want to pay tax on that, right? They're going to try to at least get this down to zero. So what do? They first would have to take any interest that they have on their home mortgage if they were using, their home as a home hobby outlet, whatever. So they'd first have to go ahead and do that. Then they'd have to go ahead and take the property taxes as a deduction. So they're wiping these out as being available for deductions in the regular itemized deductions, right? They make you use those up first, okay? Then they go ahead and, I guess since this guy was raising horses, so any operating expenses like vet bills, that's the second tier. Feed, he has to take that, okay? So now what? Now he's up to 15,000 here. And so the next category that he can take would be depreciation, and the depreciation is what? Limited to 500 as a deduction. And the reason it's limited to 500 because he can only take 15,500 up to his hobby income. Okay, so they'll go through and they'll make you use up this order. If his interest was 15,500, he'd be done right there, right? And he would take that 15,500 and he wouldn't have to go down to these later tiers. Now he can't take that deduction as an interest deduction for his itemized deductions. He's used it up here. Okay, so they've got those rules there. Best thing is to have them keep it a business if you can, right? Okay. All right, good. Come over. And which of the following is not deductible, and it's what? Allowable hobby expenses in excess of hobby income, right? If it's a hobby, they're going to only let you deduct up to whatever your hobby income is. Okay, good. Let's take a look at rental vacation home. Okay, so what happens? You have a vacation home, you have a cabin up in Tahoe or something, and you're sitting there and you're saying, that cabin sits empty all the time. I'm going to start to rent it out. Okay, the question is, can you deduct the cost of that as a rental, or is it personal property, or is it going to be, and they have sort of a middle category where it's considered both a rental and personal use. Okay, so if it is considered primarily personal use, and when we're talking about primarily personal use, notice here that if the residence is rented for fewer than 15 days in a year, it is treated as a personal, and I couldn't get rid of the hyphen for some reason between resi and dense. It would not delete, so okay, you don't have to have a hyphen there. But if the residence is rented for more than 15 days in a year, it is treated as personal. Okay, now if that's the case, then the rent income is excluded from gross income. Pretty good, right? You don't have to pay tax on that. It's excluded. And what? Mortgage interest and real estate taxes are allowed as itemized deductions because we're looking at now as a residence. So they will have you treat that as a residence, and you can deduct the what? You can deduct the property taxes and the interest as an itemized deduction. So it's going to be a deduction from AGI, not for AGI, because they're declaring that what? Personal use. You didn't get into any sort of business activity significantly enough, fewer than 15 days, to be able to be considered like an investment type property. It's a personal use property. Okay, no other expenses are going to be deductible, so you're not going to be able to deduct any of the utilities, any of that stuff. Okay, good. Now you come over. And we could have it, let's look at Catherine here. Catherine owns a vacation cottage on the lake And during the year, she rented it for $1,600 for 2 weeks. So what's happened? 2 weeks is how many days? 14 days. So she's used it for she's rented it for less than the 15 days, right? She lived in it for 2 months and it was vacant the remainder of the year. The year's expenses amounted to $6,000 mortgage interest, $500 property taxes, $1,500 utilities, maintenance, and depreciation. Okay, and because the property was not rented for 15 days, the income is what? Excluded, and the mortgage and the property taxes are going to be deducted as what? As itemized deductions, right? The remaining expenses are not allowed. They're considered personal because they're considering that a personal residence, because she rented it for less than the 15 days. The good news is she can't deduct the expenses, but she doesn't declare the income, right? Okay, good. Now you come over and you take a look at the next slide here, and we have the next possibility, which is primarily rental use. So now she has rented it. No, I don't know if it's he or she. If the residence, he or she, or her residence is rented for 15 days or more. So now we have done what? We've gone over the basically 14-day category, because they say less than 14 days. I mean, I guess it could be 14 and a half days or something stupid, but you go over 14 days, now we're into the 15 days or more in a year, then it is not considered a personal use and is not used for personal purposes for more than the greater of 14 days or 10% of the total days rented. And for most cases, right, there's 365 days in a year, so 14 is almost half of the whole year. And so for most cases, it's going to be 14 days, okay? So it is rented for 15 days or more in a year and is not used for personal purposes for more than 14 days. Then you can go ahead and say, well, you know what, that was primarily a rental use property, right? Okay, because you didn't use it that much and you rent it out to other individuals for a significant enough period of time that we're going to be calling it primarily a rental use. Now, if that's the case, you still have to allocate your expenses between the personal use and the business use, the rental use. Okay, so you still have to allocate the expenses between those. Real estate taxes allocated to personal days, you can still take as itemized deduction. On the interest, they go and they have a little bit of a weird twist here in that they tell you for the interest, they are not going to allow you to deduct the interest as an itemized deduction for the personal use portion, because that was not your primary residence if you didn't use it long enough for it to qualify as personal use property. Okay, so they'll let you take the property taxes as an itemized deduction, not the interest. Okay, and then the deduction of the expenses allocated to rental days can exceed the rent income, and so the big deal here is what? We can take a rental loss. Why? Because we rented it out enough and we didn't use it ourselves enough to kick it into another category that we're going to see here in a minute, and so they allow you to treat that as though it was like a business, like a rental property, like an income producing property. Yes, sir.
What happens if you're renting out a room or two, but you're also still spending
Well, that's going to be a completely different category. I mean, I think that would be your personal home, and then you'd have to go ahead and declare the income on a Schedule E, and then you would be able to deduct any portion of the expenses that are attributable to the square footage of the house that was for the rental or something. You have to do some sort of allocation that way. So you're living there the entire year, right, in that scenario? So, you're going to have to, and so are those other individuals. So we're not into this kind of 15 days, 14 days. It's 365 days that you live there. It's not a vacation home. It's your primary residence, right? And so if that's the case, then you would take your itemized deductions for the personal portion of your interest and your property taxes and that, and then you have to have some allocation basis of putting some of that over to the Schedule E as a deduction against the rental income that you're getting. Okay. Okay, so let's go ahead. It's the same ballpark, but a little bit different. Catherine owns a vacation cottage on the lake. Okay, so these are like vacation homes, right? During the current year, not your primary residence that you're renting out. During the current year, she rented it for what? $1,600 for 2 weeks. Lived in it for 2 months. So what's happened? She's rented it for 2 weeks, so she's less than 14 days, and then she did what? 15 days it's rented out, but she lived in it for 2 months, okay, and left it vacant the remainder of the year. Expenses amounted to $6,000 for mortgage expense, $500 for property taxes, $1,500 for utilities. Now, when you look at the fact pattern and the amount of time she spent there, because the property was not rented, because the property was not rented for at least 15 days, the income is what? Excluded from mortgage. Insurance, property taxes are itemized deductions, and the remaining expenses are non-deductible, right? Okay, and we had sort of looked at that earlier. Now, come over here, and I put that same fact pattern because now they say assume that in example 32, she used the cottage for what? 12 days and rented it for 48 days. So what's happened? She's under the 15-day threshold, right? Okay, and so she's good there. Okay, she's not going to have to consider any personal use. So the threshold for personal use, the 14 days, which is the greater of 14 days, or 4.8 days, which, as I said, usually the 14 days is going to be the greater, because she rented the cottage for 15 days or more, but did not use it for more than 14 days, it's treated as a rental property. However, the expenses need to be what? Need to be allocated, and if you look at the number of days, it's 80% rental, 20% personal. I think you'd put the 12 on top of the 48 to get the 80-20 breakout, right, between personal and rental. Okay, and so she has to sit there, and she has this $4,800 of income, and then she starts to apportion the mortgage, the property taxes. 20% of the 500 is 80%, I should say, is 400. The utilities, she can take 80% of that. The depreciation, she can take 80% of that, and she can do what? Report a loss here, right? Okay. Now, for the personal, she cannot take a rental loss. However, she can do what? She can go ahead and she has itemized deductions for property taxes of $100 associated with what? With the personal use, but she can't take the mortgage because she did not stay there enough of the time for it to qualify as a what? As a resident, so she can't take that as an itemized deduction, but she can take the property tax. Okay, now the third possibility is that it is a personal use / rental use. Okay, so we're going to get into some more of these days considerations. If it is rented for more than 15 days and is used for personal use, what? Now more than the greater of the 14 days, or 10% of the total days rented, which is usually going to be more than the 14 days. That person a minute ago, that lady, whatever her name was, Carolyn or whatever, she was at 12 days, right? So she hadn't exceeded that. You exceed that, you get to that 14 days or more, the expense must be allocated between personal days and rental days. Expenses are only allowed to what? To the extent of rental income. So what does that mean? That means you cannot take a loss on that. They won't let you take a loss because you've used it too much for personal use. Okay, so now we're going to go ahead, Catherine, I guess is her name, and assume that Catherine did what? Assume that she, God, that's irritating. Assume that Catherine, in this example, rented this for 32 days, so she's more than the 15 days, so she can't just assume that it's not a rental. And for 30 days, lived in it for 30 days. So she didn't rent it for 32 days. It's example 32. She rented it for what? 30 days and lived in it for 30 days. The threshold for personal use, 14 days, which is 14 days, or the 3 days, which would be 10% of the 30. She's exceeded that threshold for personal use. So the residence is now classified as what? Personal rental use property. She used it more than the 14 days and did what? Rented it for more than 15 days. So the expense must be allocated between the personal use and the rental use. Rental expenses are allowed, but what? They cap that at the rental income. So you can't take a loss on that. There's no loss on these that fall into this category. Okay, so you take a look, and well, again, let's just, before we jump out of this, let's just think about this for a second. So what's happening? She's using it, what, too much for personal, and what, too much not to call it a rental. So they say it's a rental personal, right? Okay, and the big takeaway there is what? You can't take the you can't take a loss on that. At that point, you can deduct up to the amount of income for the rental. Okay, so take a look. If a residence is used primarily for personal use, rented for fewer than 15 days, which of the following is correct? No income is included in AGI. And what? No expenses either, right? Okay, now you're probably looking at these and saying, so we got to memorize, or we're going to have to make sure we have in our notes how many days here and how many days there, and we're going to have to navigate ourselves through a bunch of days. And the answer is no. Okay, I could care less about your ability to remember how many days or what. What I will do is I'll give you a problem like this where they call out, it is personal use, it is rental use, it is personal rental, and then I'll expect you to be able to, understand what the rules are, accordingly for those different categories, and you can bring in your notes and look that up at that point in time. So, but I'll have it called out what kind of use it's for. I'm not going to make you memorize the days or navigate through the days or have to look up the days, because it's dumb to make you do that. Because what would happen? Somebody would come in and you're doing their tax return, and you would ask them, well, how many days did you rent it? How many days did you use it? You'd write that down, and then you'd go look up to see what category they fell in, and then go accordingly to whatever it is they're supposed to do. So, okay? All right, good. Come over, and let's take a look. Yeah. No expenses are deductible. Oh, well, no, it's a good question, though. You can see down there they answered that in the rationale, in that she can still itemize as for the personal, right? So it's deductible for personal purposes. So it's an itemized deduction. It's a deduction for, not a deduction for, but a deduction from. That's a little bit tricky. Okay, good. Let's take a look. Robin rents her beach house for 60 days and used it for personal uses. What's your name again? Maggie? Like modified adjusted gross income, Maggie? Okay. All right, so, geez, I guess we're never going to be the same after taking this class, right? Okay. All right, so what happens? You sit here, and Robin rents her beach house for 60 days, Maggie, and she uses it for personal use for 30 days during the year. the rental income is $6,000. So even though they didn't call it out, I would look for some that would call it out, or I'd have to edit the question to call out. It is a slash what? Personal use, rental use, right? Because she's exceeded the minimum days, obviously, and she's exceeded the minimum days to just call it a rental, okay? And she's exceeded the minimum days to not have to deal with any of this, not declare the income, not declare the expenses, okay? So she has this mortgage interest of 9 and the real estate taxes of 3. Now you look at that and you say, well, wait a minute, she should be limited to the 6 as a deduction because she can't take a loss on this, right? But she can do what? She can go ahead and take the $12,000, the answer here, because she can take the mortgage interest and she can take what? The real estate taxes, because she can still deduct them as what? Itemized deduction. So when they say deduction here, they mean deduction either for or from AGI, right? Okay. Okay. So after all that, the answer is what? Don't rent out your vacation home. You can avoid all that. Okay. Let's take a look at Bob and April own a house at the beach. The house was rented to unrelated parties for 8 weeks. That's clearly more than what? 15 days, right? For 8 weeks during the year. April and the children used the house for 12 days, so we're less than 14, aren't we? Okay, so if that's the case, this is a rental, right? Okay, so we come over, and after properly dividing the expenses between rental and personal, even though it's a rental, you still have to divide those expenses accordingly, right? By the number of days that it was used for each activity. And after properly dividing the expenses between rental and personal use, it was determined that a loss was incurred as follows. And we have what? We have this $1,500 loss. And guys, this is the rental use. I don't know if when I brought the question over, the table didn't copyright or something, but that column is the rental. And so the answer is what? A, they can take that $1,500 loss because it is a rental property, right? Okay. Okay, good. And again, I'm going to look for ones for the exam that just call it out as rental, or this 12 days, but not more than that many days. I don't know. Something like that can be looked up. Okay. Expenditures incurred for taxpayers' benefit or obligation. No deduction is allowed for payments of another taxpayer's expenses. So someone can't come in and say, hey, no problem, I'll pay for your interest on your house and I'll deduct it on my taxes so that I get the deduction. Don't worry about it. No, I mean, you'd have all kinds of schemes that would start to erupt around town, right? People would start selling their interest deduction to higher income individuals, right? And so they're not going to allow that to happen. Now, there is an exception, and the exception is if it's a payment for medical expenses, and I think it's kind of screwy that they say medical expenses of a dependent. That's fine that it's for a dependent. I mean, I guess then people could be going around selling their medical expenses deductions, and, you know, rich people would start paying poor people's medical expenses and taking the deduction for that. But is that really that bad? I don't know. You guys have heard of Al Davis? Remember Al Davis was this old guy who owned the Oakland Raiders, and they always used to say that when he found out that someone was seriously ill, maybe one of his players, former player's spouse or something, he would always come in and say, hey, you know, I want to pay for the best medical care, the whole kind of thing. And that was how he decided that he was going to use his fortune, right? His good fortune. I'm thinking that's a pretty good way to use it, right? Well, maybe we should, you know, help the dude out in that process and let him deduct. the portion of the medical expenses that he's paying that's in excess of the person's age, in excess of the AGI, whatever. I don't know. Just I'm not sure why they don't allow that. I could think that might be a good public benefit thing. But anyway, stopping right there, no deduction is allowed for payment of another taxpayer's expense. It must be incurred for the taxpayer's benefit or arise from taxpayer's obligation. This is redundant. The exception is what? Payment of the medical expenses of who? Got to be a dependent, right? Okay. Now you come over, and I don't have an example question with that. That's just sort of self-explanatory. Oh, yes, I do. So Melba incurred the following expenses for her dependent daughter the current year: payment of principal on the daughter's automobile loan, payment of interest on above loan, blah, blah. And then what? No medical expenses. Can't take any of that, right? I mean, that would be a scam all the time. The parents would step in and pay all their kids, itemized deductions, take them for themselves, right? Okay. All right, good. Come over and let's look at capital expenditures. Capital expenditures have to be capitalized, and then they will be subject to depreciation. So, in other words, the federal government is coming in and saying, we're not going to get into the business where you go and buy a new building for $10 million and you take that as a deduction, because it's a what? Ordinary and customary business expense. So when it's for a capital item, they're going to make us capitalize that, put it on the balance sheet, and what? Depreciate that. Okay? Now you come over and you take a look at the next slide, and the deductions are not allowed for the payment for new buildings or permanent improvements or betterments. Okay? Incidental. Excuse me. Thanks, guys. Incidental. You're so polite. Usually my classes just let me sneeze and they don't say anything. Then like somebody else sneezes, chew, and everybody goes, the whole class goes, bless you. I'm like, well, what was wrong with my sneeze? It wasn't cute enough. Okay, so incidental repairs and maintenance of property taxes are capital expenditures and can be deducted as ordinary expenses. So they give us a couple of examples here. For example, repairing a roof is a deductible expense, but replacing the roof, you'd have to do what? Capitalize that, right? Okay. A tune-up of a delivery truck or whatever is an expense, but if you completely overhaul the engine, and they say probably because there's probably some dividing line between when it's normal and an overhaul, but once it crosses a certain, mechanics threshold, then they would consider that, to be a capital expenditure. With my luck, I would go ahead and deduct it, and then, I'd get an IRS agent whose hobby is fixing up cars on the weekend or something, and they'd be able to say, well, that's the crossover. So, okay, so it's a judgmental thing. But materials or supplies that cost $200 or less can generally be deducted in the first year they are consumed. So you buy something like a bunch of paper and it costs $200, they're going to go ahead and let you deduct that. Okay? You have to capitalize things like paper, I guess, supplies, that kind of stuff. Okay? Now, we take a look, and year one, Corporation Biz purchases 100 cell phones for its employees to use, each phone costing $130. Well, that must be some great cell phone. Cost $130. Each cell phone is considered to be a unit of property. During year one, 60 of the phones are put into use. The remaining phones are not used. Since the cell phones cost less than what? $200, then they are considered to be material and supplies. Therefore, the 60 phones can be expensed, total of $7,800. So each phone, so it's each unit, right? And each phone is considered a unit. So that's how they got it up to $7,800. The remaining phones that were not put into use cannot be expensed until they are put into use in year 2. Okay? Let's take a look at this next one. Jared owns a building. It has 10 apartments. During the year, one of the apartments needed a new stove. Jared paid $800 for the stove, including $75 of sales tax. Also paid $50 for the stove to be delivered and an extra $60 for it to be installed. Any cost that you incur to get an asset into your business so you can use it productively is part of the cost of that asset, right? That's a GAAP rule. That's a tax rule. Okay. Now we come in and we say the stove is considered to be a unit property, and all of these costs are included. 910. It is capitalized and it will be depreciated, right? Okay. Okay, good. Come over and let's take a look at section 267. Disallows losses from direct or indirect sales or exchange of property between what? Related parties. Family members. And entity relationships apply. Constructive ownership rules apply, and loss allowance may reduce gain on subsequent disposition to a third unrelated party. Okay, so they don't want you know, selling a stock to your kid for this huge loss and then you take the loss, right? But then the consideration is, well, maybe I could have sold it to a third party for a loss. So should I completely lose that loss? No. They'll let you carry that loss forward, and then you're going to be able to deduct that off of any gains in the future if you sell that thing later on for a gain. So let's just take a look at how that works, okay? And they tell us that losses are disallowed from exchanges of property between related parties. And they tell us that a right, where's my colors? They tell us that a right of offset is created equal to the disallowed loss. When the property is subsequently sold to a non-related third party, any gain recognized is reduced by the right of offset. However, the right of offset cannot create a loss or increase a loss beyond that original loss. Okay? And so let's just go ahead and take a look at this. Frida sells common stock with a basis of $10,000 to her son Bill for its fair market value of $8,000. So there's a what? $2,000 loss there, right? Can she take that loss? She cannot, because what? She sold it to her son. You can't sell something to a related party for a loss. So the $2,000 loss is not recognized, but it does create a what? $2,000 right of offset when he sells the stock. So he sells it later for $11,000. Frida's $2,000 loss is disallowed upon the sale to Bill, and what? Only $1,000 of the gain is taxable, which is the $11,000 selling price minus his basis. He bought it from his mom for $8,000, right? So you're thinking what? There's a $3,000 gain there, but he only has to take $1,000 of that gain because he's entitled to what? To this $2,000 offset because the mom didn't take the loss when she sold it to him, right? I don't like this last part. Oh, yeah, let's look at this fact pattern. I'm okay with that, but then that very last note kind of annoys me. But let's just go ahead and let's take a look. And we say, assume the same facts as example 45, except that Bill sells the stock for $9,000. Bill's gain is going to be what? $1,000. $9,000 selling price minus the $8,000 basis, and it is what? It is not recognized because of the right of offset of $2,000. So he's not going to have to recognize any of that because what? Because there was this $2,000 offset, but that's it. The stock is gone, right? Okay, so the note says, well, geez, you know, she could have had that full $2,000 loss if only she had sold it to a third party when she sold it to Bill. Yeah, but what about the $9,000 that came in later? You know, I mean, let's sell it now so we take a deeper loss in case we have some gain later on. I mean, that doesn't exactly make a whole lot of sense unless somehow that loss would push them down into a lower tax bracket, or maybe the mom's tax bracket is lower than the kids. I guess that would be a consideration. So, okay, but that full 2,000 loss never got to be taken on that because the stock's gone now, right? And he only was able to avoid paying tax on that $1,000 gain. All right. Questions, guys? Okay, chapter 10, Tuesday. Thursday, probably finishing chapter 10, getting into the practice midterm that I'll have to get ready and put up. And that means Friday, you want me to come and talk to you on Friday? Okay, so Friday, I'll come and talk to you as well. I just got to figure out something. I'm supposed to take my dad to the doctor, but I got some other option. Okay, so that's the game plan, and then obviously we take the test the week after that, okay? All right, guys, I'll see you on Tuesday. If you're seeing chapter 10 up there right now, I haven't put deployed homework assignments yet for chapter 10, and I haven't finished picking quiz questions yet, so don't print those slides off yet. If you're printing the slides, wait until like Monday or so, and I'll have the questions embedded in, and I'll have the homework questions up there this weekend. And then Derek will be here tomorrow with chapter 6 stuff, okay? All right, guys.